Good evening, class. So today's lesson is about inventory valuation, the LCNRV, or lower of cost and net realizable value. Last meeting, we discussed the types of inventory. So here's a brief summary. Last meeting, we talked about what forms or what comprises the inventory balance. So number one, it's merchandise purchased and held for resale. So these are your merchandise inventory of a retail business. So these are called inventories of a trading concern. Inventories are also comprised of those in the process of production. So these are inventories held by manufacturers. So these are inventories of a manufacturing concern. So some of these inventories are raw materials, factory or manufacturing supplies. The difference between raw materials and manufacturing supplies is that manufacturing supplies are called indirect materials, while raw materials can be traced directly to the product itself. Manufacturing supplies in also include those small value products, like for example small value items that like nails. You can barely see them in the finished product, so you can only indirectly trace them back to the finished product. uh, those goods that are still in process or are not yet finished, and of course finished goods. So what is the basis for recognition of inventory? So first of all, inventories are recognized by the entity who holds title to the goods. In the Philippines and also in other countries, title passes when goods are delivered by the seller to the buyer. So in other words, it's received by the buyer. The exception to this rule is when the title to the goods are retained by the seller in an installment sale. So even though the title is retained by the seller, the inventory is still recorded by the buyer because for all intents and purposes, the risks and rewards associated with ownership are transferred to the buyer. So this is a clear example of economic substance prevailing over legal form. One thing to note is that goods ordered are not yet considered inventory because there is no delivery yet. You can still, or the buyer or the potential buyer can still cancel the order. There's an issue with goods in transit. So who owns goods that are in transit? As discussed last meeting, if FOB origin, shipping point, title passes upon shipment of the goods. So meaning, goods in transit are owned by the buyer. In FOB destination, if the Incoterm is FOB destination, title passes to the buyer only upon arrival at the port of destination. So that means goods in transit are owned by the seller. So how about consigned goods? So to recap, consigned goods are those goods that are transferred to a consignee, but title to the goods are retained by the consignor. So the consignee, or the one that's holding the goods, only act as an agent who sells the goods in behalf of the consignor. So that means the consignor still owns the goods even if it's not physically in his possession. So that in accounting, the consignor includes the cost of the goods in his books, but the consignee excludes it from theirs. We also discussed what forms the cost of inventories. So number one is the cost of purchase. So these include the purchase price, any import duties and irrecoverable taxes paid for, and includes the freight, the handling, and other costs directly attributable to the acquisition of finished goods, materials, and services. We also discussed the conversion costs. So these are costs of labor and also of fixed and variable production overhead. So these include light and power, rental, and other costs that are indirectly related to production of the goods. There are other costs also that are that forms part of your cost of inventory. These are costs mainly to bring the inventory to their present location and condition. So to bring them so that you can use them in your production, or you can sell them as is. However, you exclude costs that are uh, somewhat abnormal. So for example, abnormal spoilage. Another cost that you exclude is storage cost of finished goods. However, you include storage cost of raw materials. This is because finished goods are already ready for sale. So storage is just an extra cost. Uh, it's not necessary for bringing the inventory to their present location and condition. Administrative costs are also outside the scope of other costs. Distribution or selling costs are also not inventoriable. We also discussed the two types of cost systems. First is periodic cost system. So in a periodic cost system, it is synonymous to a physical count. So what we do is we count the inventory at the end of the period to determine the cost of ending inventory and the cost of goods sold. So it's synonymous to this equation right here. So you add net purchases from beginning inventory to get the goods available for sale. You deduct the ending inventory to get the cost of goods sold. So what you do is just count ending inventory, and then whatever you get, you multiply by the cost, and then you get the cost of your ending inventory. You deduct it from the goods available for sale to get the cost of goods sold. So that's periodic. You do it at every end of the period. The other cost system is called perpetual. So it requires the use of stock cards to account for inventory inflows and outflows. So stock cards mainly just account for the inflows and outflows of inventory. So it includes the quantity, uh, it includes the unit cost of the inventory, and the total cost of those inflows and outflows. Inventory increases and decreases are booked immediately, and the balance is up to date. So that means if it's booked immediately, then the merchandise inventory balance theoretically is up to date. However, there is a need for a physical count at least once a year to confirm if it is accurate. We also discussed the different cost flow assumptions. So if you can remember, IFRS allows two methods or two cost flow assumptions, namely FIFO and um, weighted average. So first, FIFO. FIFO means first in, first out. The assumption here is that goods first purchased are first sold. The cost of ending inventories in a FIFO cost flow assumption, using a FIFO cost flow assumption, whether it be a periodic or a perpetual inventory system, the cost of ending inventories will still be the same. Uh, Consequently, the cost of goods sold will be the same whether it's periodic or perpetual for a for an entity using the FIFO cost flow assumption. The other cost flow assumption is the weighted average. The weighted average, using a periodic system, there's only one average. However, when used in conjunction with a perpetual inventory system, it is called a moving average because you will compute weighted average for every purchase or purchase return, or after every purchase or and purchase return rather. So in weighted average, the total cost of goods available for sale is divided by the total units of goods available for sale to get a weighted average. As I said earlier, in a moving average or in a perpetual inventory system using the weighted average cost flow assumption, it is called a moving average. As you can see in the example, every time there's a purchase or a purchase return, you have to compute the weighted average cost of the inventories on hand. Okay, so that is for every purchase or purchase return. Now let's move to the topic of today's video, which is lower of cost and net realizable value. So IFRS, or past 2 rather, states that inventories shall be measured at the lower of cost and net realizable value. So it is the measurement for inventories. So what is NRV, or net realizable value? It is the estimated selling price of the inventory less any costs needed to complete it and the estimated cost of disposal. So it's done on an item by item basis, except when the items cannot be practically evaluated separately. So what you do is, when you get the NRV, you compare it against the cost stated in the books, so it's the historical cost. And if the cost is lower than net realizable value, then you don't have to adjust the books because, of course, the past 2 requirement is lower of cost and net realizable value. If the cost, however, is higher than net realizable value, then you must adjust the books to net realizable value using either the direct method or the allowance method. So the direct method is also called the cost of goods sold method, and the allowance method is called the loss method. So what's the difference between the two? The direct method is that any loss on inventory write down or gain on reversal is not accounted for separately. So it's buried in the cost of goods sold. I will show you an example in a few moments. The allowance method, on the other hand, accounts for the loss on inventory write down in an allowance account. So it's accounted for separately. If the required allowance increases, an additional loss is also recognized in the books. If the required allowance decreases, there's a gain on reversal, but it is only recognized to the extent of the allowance balance. So in other words, the allowance for inventory write-down account can never be a debit balance. So let's go into our problems. So let's go to problem 12-3. So Winter Company provided the following inventory data at the end of the first year of its operations. So you have skis, boots, ski equipment, and ski apparel. So cost for skis is 2.2 million, its NRV is 2.5, boots 1.7, NRV of 1.5 million, ski equipment of 700,000, while its NRV is 800,000, and ski apparel of 400,000, while its NRV is 500,000. So let's do a LCNRV of Winter Company's inventories. So for skis, of course, lower of cost and net realizable value of 2.2 M. For boots, it's 1.5, the NRV. ski equipment 700,000, and ski apparel of 400,000. So you have a total LCNRV of 4.8. So as you can see here, it's an item by item basis. So what are the entries? Under the direct method, it's very simple. You just bury it in cost of goods sold. So in essence, you just record the ending inventory as 4.8. That's it. And then it will be buried as part of the cost of goods sold. However, in the allowance method, you have to uh, account for it separately. So you have to make a loss on inventory write down, or you have to recognize a loss on inventory write down of 200,000 and an allowance of 200,000. So in effect, that loss will still be accounted for as part of your net income, but then it will be separately accounted for. So separate from your cost of goods sold account. So either way, direct method or allowance method, you'll get the same net income. What if at the end of the second year, the cost of inventories is 4.6 million and NRV on an item by item is for 550 million? What I mean to say here is that when you get the lower of cost, it's already for 550. So under the direct method, it's the same thing. You put the lower of cost and NRV into the ending inventory. So in effect, it will be buried under cost of goods sold. Under the allowance method, you compare the per books of 4.6 and the lower of 4.6 and 4.550. Okay, I have not changed that. So you have a required allowance of 50,000. You compare it against the allowance balance in year 1 of 200,000 and you get a gain on reversal of 150. If this is the entry to record the gain on reversal. If at the end of the third year, however, you get a cost of 4.7 and NRV on an LCNRV item by item basis is 4.9. So per books is 4.7, lower of cost and NRV is 4.7 as well. So you have a required allowance of 0. However, you have an allowance balance of 50K. So you have to recognize a gain on reversal of 50,000. If you notice, the gain here is up to the extent of the allowance balance only. Now, what about purchase commitments? So, purchase commitments are actually obligations or contracts to acquire goods at a fixed price and quantity at a future date. So, that's it. When the price for these goods decline, then there is an expected loss from the commitment, since you are obligated to buy it at a higher price than the market. If cancelable, the loss can be avoided by simply canceling the purchase commitment. So in this case, no loss is recognized. However, if the contract is firm and non-cancelable, a loss on purchase commitment is recorded in the period of decline in prices. If market prices rise subsequently, a gain on purchase commitment is recorded, but similar to problem 12-3 or the allowance account, it is recorded but limited to the amount of loss previously recorded. Consequently, if no loss was previously recorded, then no gain should also be recognized. Let's look at problem 12-6 for purchase commitments. On December 31, 2020, Naysayer Company has an outstanding purchase commitment for 10,000 gallons at 200 pesos per gallon of raw material to be used in the manufacturing process. So what we have to do is to prepare the journal entries at the end of the following independent assumptions. First assumption, the market price on December 31, 2020 is 210 pesos. So here, 210 pesos is the market price. You booked it at 200 pesos a gallon for 10,000 gallons. So since the market price is more than the purchase commitment, no gain is recorded initially. It is expected that the market price will decline to 170 pesos in early January 2021. So a month from now. No loss is still recognized. So it's still a possibility as of date. You only record a loss when there is an actual decline as of reporting date and not an expected decline. Otherwise, you'll be booking losses if that's the case when it has not happened yet. Okay, so the market price on December 31, 2020 is 170. So the previous example, it is only expected to decline in January. But in this example, the market price are there, it already happened. It's on this date, it's only 170 pesos. It's lower than what you have committed for. So you have a loss on purchase commitment of 300,000 pesos. So you compute it as the difference between the 200 peso commitment minus the 170 market price, so 30 pesos, times the 10,000 gallons, or the quantity that you have committed to buy. So that's 300,000 pesos. You have a loss on purchase commitment and a liability of 300,000 as of December 31, 2020. So what if the market price drops to 150 on January 31, 2021? So January 31, 2021, it drops to 150 pesos. So it's 170 on December 31, 2020, and then it dropped some more to 150. And it's already received, or the commitment was already shipped. Okay, so you have a 300,000 loss booked on December 31, 2020. A month from now, when you receive the shipment, you also book the purchases at 1.5 million. So that's the market price, because you remember you don't book assets at higher than their recoverable amount. So it's always lower of cost, or NRV. Then you close the liability for purchase commitment, since the commitment has already been fulfilled, and you add on an additional loss of 200,000 for the year to account for the difference between the selling price at December 31, 2020 of 170 and the market price at January 31 of 150. So that's 20 pesos per gallon, and you receive 10,000 gallons. And you book the payable of 2 million for the 200 peso per gallon contract. Now, what if it dropped to 170 on December 31, 2020, but upon receipt of the shipment, it already increased to 210 pesos, so more than the contract. So it's a gain. So of course, it's the same. On December 31, you recognize a loss of 300,000 and a liability of the same amount. When you actually receive the goods, it is recorded at lower of cost, or NRV, right? So instead of 2.1 million, you record it at 2 million, because that's the actual cost that you'll be paying. You close the liability of 300,000, and you have an actual gain of 300,000. So you're just reversing the loss that you have previously recorded in your books in 2020. So that's it. I hope you learned something, and contact me if you have any questions.